All right, it's the day of love, and we know, viewers, how much you love your money and investments. But are you giving your investments the love and attention they deserve? You see, as an investor, you must invest varying levels of efforts and time for the asset class to reward you with handsome returns. And so, on the ET Money Show today, we'll help you better understand your relationship with investments. And for that, let's bring on board Pranjal Kamra, CEO of Finology Ventures, and Neha Nagar, Finfluencer. Hi, good evening, and welcome to the show. And today we are going to talk about investments on the day of love, which is Valentine's Day. So happy Valentine's Day to both of you as well. But let's talk about investments which are made for each other, okay? And I'm going to come to you one by one. So starting with you, Pranjal. We obviously focus a lot on asset allocation. We focus a lot on having a proper mix in terms of exposure to a particular asset. But then if we talk about combination of investments, which would be your first investment joda, if I can call that, made for each other?
Oh, nice question. Uh, whenever I'm starting to invest, first thing, and I think the new generation sort of finds it really boring. But one thing we need to realize is that gold is one instrument that kind of protects you from the country risk. So if tomorrow we often see that some countries currencies being devalued, there's suddenly high inflation and things like that. Gold is one instrument that really protects you from all kinds of domestic political risk, anything going wrong within your country. So gold is one that you should definitely have. And with gold, once you have invested in gold, also comes that now you take exposure towards, aspects that actually help you maximize your returns in terms of where your country is going. And how do you play the growth story of your country? By investing in your country's businesses. So I think gold is a great counterbalance, is a great balancing force to equity, and equity in gold is a perfect jodi.
All right, Neha, according to you, what's the perfect jodi of investment?
I completely agree with Pranjal sir, whatever he has said. So whenever we are starting investing, my first recommendation or my first advice to start with is index fund. Like if we are very, very bullish on India's growth, and we have already seen we are adopting digital India campaigns and 5G rollout all over. So now we are very positive about some kind of industries. So we can start with index fund then, and after learning more about industries, and if you have knowledge in particular that industry, then we can go on funds which are industry focused. So these two can be my first go to jodas for investment.
Okay, all right. Let's talk about showing love to your investment and understanding the kind of relationship you have with your money. Okay, like all your relationships in life, Pranjal, you need to have a certain kind of rapport with money also. And when we talk about money, you cannot miss out investment. When you talk about investment, you cannot miss out asset class. So let's take this one by one. Let's talk about the kind of love and dedication and the faithfulness that you need to show to a particular asset class. So you mentioned gold in your first answer. So let's talk about showing love to gold, which Indians by default do a lot, but in a wrong form. Let's talk about
Absolutely.
showing love to gold in an investment form.
Right. Oh, I'm so glad you brought this up. So yes, while Indians absolutely love gold, they don't know how to show it, like a lot of Indian couples as well. Uh,
Okay, now
so
that's a
the right
debatable point. We are going to get a lot of questions on that on the social media from you, okay? And I will take tips from you in the end of the discussion also for that.
so so the right way to show love to gold is actually sovereign gold bond for reasons such as when you're buying physical gold, you pay certain amount of GST. As far as I know, it's 3% on certain gold coins and bars, and higher on jewelry, and then you pay between 7 to 15% of making charges. So you end up paying 20% more from the actual price of gold. Whereas when you're buying sovereign gold bond, you don't pay any GST, you don't pay any making charges. Plus, if you're buying it through the secondary market, you can actually get it for up to 5 to 7% of discount. So effectively, when you compare it with when you're buying a gold jewelry versus a sovereign gold bond, you can actually get a discount of up to 25%. 25% discount in gold, it makes it really, really good. So gold is definitely a yes, but if you really want to show love to it and actually consider it as a good investment option, then sovereign gold bond is the way to go.
All right, sovereign gold bond. That's Pranjal's answer. How would you want investors to show their love towards gold, Neha? I mean, I'm sure you will agree. We all agree to what Pranjal said. But then, what can be other way? Let's talk about gold ETF, gold funds. Let's talk about digital gold, which is in vogue these days.
So, Kavita, first let's talk about how we can how we can show love to our relationship. So, whenever we are showing love to our partner or our money, first we need to understand it and we need to know them. Likewise, we need to understand our whatever product we are choosing. Like if we are choosing gold ETF or we are choosing sovereign gold bond, so we need to learn about it and we need to have set realistic expectations about that product. Key this can give me this much return, and how we can set realistic expectations. We can see the past return that has given. So, like Pranjal sir has already said, gold has given inflation beating return in the past. Whenever we are taking 10-year return or 20 years, so it has definitely beaten inflation, and over and above it has given 1 or 2% return. So even after taxes we are saving a lot of money. We are getting some kind of return on gold also. So sovereign gold bond definitely a good option. And then second is ETF, but again we need to learn more about it. After learning more about it, we can invest in ETF also.
So, Pranjal, when we talk about loving a particular asset class, and in this case, if we talk about gold, sovereign gold bond, I think they have a lock-in for around 8 years, okay? But then talking about having this in your portfolio, having this as one of the partners in your entire portfolio, what is the relationship term, if I can say that, the relationship duration that one should have in gold, and what should be the exposure amount in the portfolio?
So, Kavita, while theoretically, yes, sovereign gold bond has a lock-in of 8 years, but that's for redemption if you actually want to redeem it through RBI and actually want to, gain all the tax exemptions. But if there's some kind of an emergency and you want to liquidate it earlier, you can any day sell it on the secondary market, and there's absolutely no lock-in for that. So it's not that the lock-in is very strict. You only need to hold it for certain additional tax benefits, but you always have an exit option. So that way, that also makes it a good investment. Plus 2.5% of interest on your invested amount. That makes it really good. See, gold is again an instrument that, my favorite and Indians' favorite holding period for gold is forever. The gold is the last thing we sell. But what's the minimum quantum that you need to hold gold for? Should be close to 3 years, because 3 years is a time period wherein, even if you bought gold at a slightly higher price, and probably then it doesn't go anywhere for a few months or probably falls, 3-4 years is a time period where at least it'll be back to to the levels where you bought at. So there will not be capital losses, most probably. There's no guarantee, but most probably if you're holding for 3 to 4 years, there shouldn't be capital loss in terms of gold. And of course, if it's sovereign gold bond, 2.5% interest savings accounts interest you're anyways getting. So that makes it a safe investment if your horizon is 3 years. But just like your goal with a partner, your goal with your partner is to spend their life. I think gold is, again, just like your partner, aim to spend life with gold.
All right. Let's move on to our another asset class, and let's talk about equity. And Neha, I want to start with you over here. What kind of love should you show to this asset class?
I think for equity, the love we need to show is we need to give it some time, space, and commitment to so that it can give us the return we want. And we need to set realistic expectation that okay, we can get 10-12% from equity, and that is enough and that is good. Apart from it, we should also see how much risk we can take. Like according to your just few minutes ago you asked how much you should put in gold. So there is a rule called 100 minus your age equals to, like, if I'm 25, so I should put 75% in risk taking assets. So equity is definitely risk taking assets. So 75% I can put in equity, and other 25% in gold, bonds, or real estate, or other kind of asset classes. And for equity to perform good, you need to wait for at least 5 to 10 years. In short run, you can have losses. Like if I started investing in 2019, and in 2020 there was a equity crash, so I could have lost all of my money if I wanted to invest for 1 year only. So for letting equity to perform, to give to equity to give you that financial stability, you have to give minimum 3 to 5 years time and commitment to grow.
But then, can loving equity be risky also? Is there a possibility or chance of a heartbreak, Pranjal?
Oh, absolutely. If it's equity, there's no guarantee. But that is why, and this is where probably equity is different from choosing life partner. You don't diversify, but in equity, you need to diversify because a single equity might give you negative returns even if you hold for 3 years, 5 years, 10 years. And to counter that risk is when you diversify, you at least. So if you are having a direct stock portfolio, the minimum number of stocks that you're going to hold is around 15. So between 15 to 25, 30 is the number of stocks you should go for, so that you're not worried about some lemons in your portfolio, because even the best stock pickers, their success rate is between 55 to 60%. So 40% of stocks even the best stock pickers pick actually don't perform. So that's going to happen, but which is why it's easy to diversify in equity, and there are 5,000 options to choose from. I think it shouldn't be difficult for you to keep a portfolio of 15 to 25 out of the 5,000 options available. Secondly, uh, we also need to understand that in equity, again, there's a minimum threshold that you only invest an amount that's not required by you for at least next 5 years. But there's no maximum threshold. If it's a good company that generates free cash flow, that's compounding its earnings and things like that, my favorite holding period is forever. So any money that you don't need for next 5 years, please only invest that. Often what happens is market is doing well. We think, why miss out? I need this money 2 years down the road. Why not invest now? In 2 years, anyways, it will double. And then it crashes and I have to take my capital with a 50% reduction. That is where the loss is, which is not a loss induced by the market, but that loss is actually induced by my lack of capacity to actually commit for the long run.
Which is why love for equity needs to be slightly planned, and you need to really work hard and do a bit of your homework in terms of achieving the kind of goals you want from this asset class. And that is how the relationship will also come out with equity if it's really planned well. So what do you recommend, Neha, in terms of doing your own homework, in terms of identifying the kind of right time horizon you should be having in this particular asset class, the kind of goal you should be lining up, knowing the risk factors, what all planning or maybe love planning that you need to do for equity?
I think for equity, for equity or any kind of investment, you first need to know about yourself, your long-term goals, your short-term goals, your risk-taking capacity, your requirements. After realizing your current situation, okay, I'm standing it here and I want to go here. Like after 2 years, if I want to purchase a car, after 5 years, I want to purchase a home, then I have to pick the investment product accordingly, that how much risk I can take to accomplish that investment goal or amount. Like if I want to take my family on a foreign vacation after 5 years, so here my risk taking capacity would be little high because I have long time, and second, the goal is not that much important. So now I can plan to invest in equity through index fund or mutual funds, and I can relax, okay, by doing SIPs, because through SIPs also I'll be eliminating some kind of volatility in the asset class plus risk. And also if I'm planning for a long term investment through equity, it will also give me benefit of compounding. So in the long term, I'll be creating wealth for myself. So whenever any asset class I'm picking, I'll first analyze myself, my risk taking capacity, my requirements, and then I'll go for rewards. Ki, okay, I'll get 10, 20, 12% in this asset class.
So over here, Pranjal, now looking at the current scenario, the intensity of loving equity can slightly be diluted and shift towards debt. Can we do that?
Oh no, Kavita. I think for retail investors, I really don't like debt. I never recommend it. I think it doesn't make sense for a retail
Not even to
investor
take
to
the
because
advantage of rising interest rate, because look, fixed deposits are very interesting, and I mean the kind of interest rate they are offering, even your debt mutual funds, especially short to medium term, if we look at, that is a space where people can really park in money these days. No, you don't recommend that?
oh, FDs definitely yes. I mean, any money that you need in the next 3 years, there's no investment option in terms of gold, equity, or real estate if you need the money in the next 1, 2, 3 years. So yes, park that safely in a safe FD or an auto sweep savings account. But you know, in terms of FDs, also we are often blindsided when going with debt instruments or FDs, and we pick them the same way we pick stocks. So, in stocks, we are attracted by higher past returns, and often FDs also we like that those are offering higher returns. So, if a safer bank is offering 7%, I would actually go with a small finance bank, would be tempted to go with a small finance bank that's offering 8.5%. That's a very wrong way to go about it. I think it's just the way we often keep telling people to keep insurance and investments separate. There's also a sub uh, bifurcation we need to do. Any amount that you need for the next 1, 2, 3 years, and you want that this amount shouldn't lose its value, you keep it in FDs. You're not going for returns. You're just looking to minimize the impact of inflation. Any amount through which you want to compound wealth, you don't go to debt instruments. Then, if you're looking for safety, go with gold. If you have a big ticket size and you want extreme safety, go with a reputed builder and probably established real estate project. If you have a lower ticket size, you're okay with volatility, you're looking for highest possible returns, go with equity. But what people do is they are looking for, instead of FDs, they're tempted to NCDs, corporate deposits, because it's offering 2% extra. And then I'm not worried about credit rating as well, because past 2 years probably I got 9%. I think it will always happen, and I'm taking more and more risk, 9%, 10%. So with debt, risk and returns are always proportional. With equities, that's not the case. With equities, your returns rise when you control risk. But with debt, it's not going to happen. Higher risk, higher return. And with debt, you're never going to outperform equity. So debt is a safety instrument. Go with the safest FDs, nothing else, nothing fancy.
Really understand the kind of balance approach they want to have for their portfolio. But then talking about the next asset class, so what about real estate, Neha? Would you show your love to real estate?
I come from a family who invests in real estate a lot. So lately, I have also started investing in real estate. So because first, my aim would be to beat inflation. Second, my aim would be to have something for my like. Real estate also gives you return on the investment with regular returns. So I've invested in commercial real estate, which gives returns, monthly returns also, and corpus returns also. So definitely we should park some amount in real estate also, but again, their ticket size is very high. So we need to research, because real estate returns depends on the location and type of property. But historically, real estate has given a return of around 8 to 10% annually, which is very great. But from 2016, we have not seen that much great returns. But last year, we have seen good returns. So in long term, if we see 10 years or 15 years return, so we can expect 8 to 10% return from real estate. But again, the ticket size is very high, so we can choose REITs, real estate investment trust units, in which we can invest very small amount, 50,000, 60,000, and start our investment in real estate. So we can diversify our portfolio through real estate also.
Let's talk about crypto, I mean, this is not a particular asset class that I really want to establish over here, because it's not legally called that. But a lot of interest, investor interest, is there in crypto. So should we consider crypto as a love that you should really not get into and not indulge yourself into, Pranjal?
Oh, break up with it. Absolutely crap. Absolutely junk category. I think no intrinsic value. See, for any asset class to be considered an investment, there has to be a basis of valuation. So how do we value commercial real estate? Just Neha mentioned, it provides us rental yield. So you do a mental calculation that this shop is worth 1 crore rupees. I'm getting 50,000 a month of rent, which means 6 lakh a year. So it'll take me 15 years to recover my cost. And now it's up to you whether it's justified or not. Stocks, they earn, companies earn. So there is earning per share behind it. There's a basis of valuation. How do you value cryptos? They don't give you dividend. There's no rental yield. There's no earning per share. They are nothing. They're piece of token doing nothing, no intrinsic value, no asset value. So I think it was just herd mentality at display in the last couple of years. And I think what has happened with crypto deserved to happen. And please, I mean, if you're really bullish about it, if you really want to play it, maybe probably 1% of your total investable corpus, just so you don't miss out. So anything that the total amount you want to invest, probably 1% invest in a couple of cryptos, but it's pure gambling in my mind, not an investment at all.
All right. So that's all for the love towards your investment that you should be showing. And thank you so much, Pranjal and Neha, for giving this information and crucial information, which often a lot of time people don't understand. It also comes with the understanding of diversification that one should have in their portfolio. So thank you so much for being on this show today. And on that note, let's take a quick break.